Inheriting gold, it sounds, well, like striking gold, doesn't it?
It really does.
But what many people don't realize is that inheriting a gold IRA, specifically, can come with this surprisingly complex web of tax rules.
Yeah, it's almost like there's a hidden tax burden sort of lurking beneath that shiny surface.
That's a really insightful way to put it. People get excited about inheriting precious metals,
I
and,
bet.
understandably so.
Of course. But navigating the tax side, I mean, both federal and state level taxes, that's really crucial if you actually want to benefit fully from that inheritance.
And that is precisely what we're digging into today. Our goal is to take the information from our sources.
Mhm.
We've got a really detailed article focusing specifically on tax rules for inheriting a gold IRA and just make it clear and actionable for you.
Right.
We want to help you understand these rules so you can potentially keep more of that inherited gold where it belongs with you.
Exactly. Because understanding these nuances, it's not just about, avoiding potential headaches with the IRS.
Hmm.
You're directly impacting how much of that inheritance actually stays in your pocket. We're talking potentially saving a significant amount of money that might otherwise just go to taxes.
Okay, so let's start with the foundation. What exactly is a gold IRA?
Okay. Well, at its heart, a Gold IRA is a self-directed individual retirement account. Now remember, IRAs are retirement savings accounts.
Right.
They offer tax advantages.
Right, the tax advantages.
And a Gold IRA simply holds physical gold instead of the usual stocks or bonds. The key thing here is instead of paper assets, it holds actual physical precious metals, mostly gold. But it can also be other IRS-approved metals like silver, platinum, palladium.
So it's not like some kind of fund that just tracks the gold price. It's actual bars
Right.
or coins.
Precisely, yeah. Think of it like a regular IRA in terms of its tax benefits. So either contributions were pre-tax, meaning growth is tax deferred until retirement, or maybe it's a Roth IRA where contributions were after tax, so growth is tax-free later. Our source here, it really focuses on inheritance. It usually implies that traditional tax-deferred structure.
Got it.
But the unique thing is, instead of holding shares, the account holds physical gold bullion coins or bars.
And setting one of these up, it's not as simple as just buying some gold and sticking it in your attic, right?
Definitely not. No, you're right. A Gold IRA requires a custodian.
A custodian.
Yeah, usually a bank or maybe a brokerage firm. They handle the admin side, the paperwork, compliance. Plus, the actual physical gold has to be stored in a secure facility, one that's approved by the IRS. You can't just keep it at home.
Makes sense. And I imagine not just any old gold coin you find will qualify for one of these accounts.
That's absolutely correct. The IRS has very specific rules about the fineness and the purity of the metals that can be held in a Gold IRA. It's all about ensuring the quality and value of what's actually in the retirement account.
Okay, so let's say you've just learned you've inherited a gold IRA. What are the first tax-related things that should pop onto your radar?
Well, the very initial consideration is whether either federal estate tax or state inheritance tax might apply. And it's really important to understand these are two different kinds of taxes.
Okay, estate tax versus inheritance tax. What's the key difference for me as the inheritor?
Right. So federal estate tax, that's a tax on the total value of everything the deceased person owned when they died, before anything is passed on to the heirs.
Okay.
But, and this is a really important point, it only applies to very large estates. For 2025, that threshold is nearly $14 million for an individual
Wow, okay.
and almost $28 million for married couples.
So unless the person who passed away had a truly massive amount of assets, federal estate tax probably won't be the main worry for most people inheriting a gold IRA.
Generally speaking, yeah, that's accurate. Now, for estates that do go over those big amounts, the federal estate tax rate can be quite high, up to 40% on the value above the exemption, specifically on the part exceeding $1 million over that exemption.
Okay.
Inheritance tax, though, that's different. That's a tax at the state level.
Ah, state level.
Yes, and it's imposed directly on the people who receive the inheritance.
Okay, so estate tax is about the estate paying before anyone gets anything, but inheritance tax is about us, the people getting the gold, potentially paying the state.
Exactly right. And the crucial thing here is that not every state even has an inheritance tax.
Oh, really?
Yeah. And for those that do, the rates and the rules can vary quite a bit.
Yeah.
So where you live, or maybe where the person who left you the gold lived, that can really impact your state tax situation.
Okay, understanding those potential taxes is step one. Now, let's explore ways heirs might be able to, lessen that burden. What strategies does our source highlight for minimizing taxes?
The article points to a few key areas. One of the big ones is simply how you choose to take distributions from the inherited IRA.
Okay, the distributions. What are the main options there?
Typically, when you inherit a Gold IRA, you have two main ways to get at the assets. You can take a lump sum distribution, that means taking the entire balance out all at once,
Mm-hmm.
or you can spread the distributions out over time.
And I'm guessing taking it all at once could have a pretty significant impact on your taxes for that specific year.
Oh, precisely. Yeah. If you take a full lump sum distribution, that whole amount is treated as taxable income in that 1 year,
Oof.
which could very easily push you into a much higher income tax bracket, leading to a bigger overall tax bill in the end. So, if the inherited amount is, say, $100,000, taking that whole $100K at once could land you in a way higher bracket than if you took smaller amounts over several years.
So the alternative, spreading it out, how does that help exactly?
Well, by taking smaller amounts each year, you can potentially manage your taxable income more effectively. This might help you stay within a lower tax bracket, meaning, a smaller percentage of your income goes to taxes. Over the long run, this strategy can really help you keep more of your inheritance.
The article also mentioned donating and gifting. How can those play a role in managing the tax hit?
Yeah, those are interesting options depending on your personal situation and your financial goals, really. If you're someone who already supports charities, you could think about donating a portion of the inherited Gold IRA to a qualified charity.
Okay.
Doing that can give you a charitable tax deduction on your income taxes, which can help offset other taxable income you might have.
So you're basically using the donation to lower your overall taxable income for that year.
Exactly. And then there's gifting. You can gift a certain amount of money or assets each year to individuals without triggering federal gift taxes. For 2024, that annual exclusion amount is $18,000 per person.
$18,000, okay.
Yeah. So this could be a way to, share your inheritance with family members
Hmm.
while also maybe reducing the size of your own taxable estate down the road.
That's good to know. Now, let's focus on the rules specifically for someone who inherits a Gold IRA but isn't the spouse of the person who passed away. What are the key distribution rules they need to be aware of?
Right. For non-spouse beneficiaries, there are primarily two options they have to choose from for how they take distributions.
Mm.
There's the 5-year rule, or there's the life expectancy method.
The 5-year rule sounds pretty straightforward. You just have 5 years to empty the account.
That's the basic idea, yeah.
Yeah.
The 5-year rule requires you to withdraw all the assets from the inherited Gold IRA by December 31st of the 5th year after the original owner died.
Okay.
Importantly, you don't necessarily have to take distributions in the years leading up to that deadline, but the whole balance must be out by then. This might be good if you think you'll be in a lower tax bracket in the coming years, or maybe if you need access to a bigger sum eventually, just understanding the tax hit of that final withdrawal.
And the other option, the life expectancy method.
Yes. The life expectancy method lets you take annual distributions calculated based on your own life expectancy using IRS tables.
Ah, okay.
This approach spreads the tax burden out over what could potentially be a much longer time. The choice between these two, it really has significant long-term tax consequences. It's a crucial decision.
Now, we've talked about how to take distributions, but what about those required minimum distributions, RMDs? Do those still apply when you inherit a Gold IRA?
Oh, absolutely. Yes, RMDs do apply to inherited IRAs, including Gold IRAs. But the specific rules depend a bit on whether the original owner had already started taking their own RMDs before they passed away.
Okay, so two different scenarios then. What if the person who left the Gold IRA was already taking RMDs?
Right. If the original owner had already begun taking RMDs, then the heir is generally required to continue taking annual withdrawals. But the amount of those withdrawals will now be calculated based on the heir's life expectancy, not the deceased person's.
Okay, based on my life expectancy if I'm the heir.
Exactly. And failing to take these required withdrawals can result in pretty significant penalties from the IRS.
Definitely something you want to avoid. What if the original owner hadn't yet started taking their RMDs?
In that case, the non-spouse heir typically has more flexibility about when the distributions have to start. They can still choose between the 5-year rule or the life expectancy method. If they pick the life expectancy method, the first RMD usually needs to be taken by the end of the year following the year the original owner died.
So no matter what, it seems like at some point the government is going to want its share through income tax on these distributions.
That's correct. Yep.
Huh.
All distributions from a traditional inherited Gold IRA are taxed as ordinary income.
Ordinary income, okay.
Which is exactly why planning the amount and the timing of those distributions is so important. Because, like we said, Larger withdrawals can push you into a higher tax bracket.
Now let's shift gears a bit. What happens if you decide to actually sell the physical gold that's inside the inherited IRA? That's where capital gains tax comes in, right?
Yes, exactly. Capital gains tax can become a factor when you eventually decide to sell the gold held within the inherited IRA. The tax rate you pay depends on how much gain there is. But there's a really significant benefit for inherited assets like this, and it's called the step-up in basis.
Step up in basis. Okay, that sounds like it could be a pretty big advantage. What exactly does that mean?
The step-up in basis essentially means that for tax purposes, the value of the inherited asset gets stepped up to its fair market value on the date the original owner died.
Ah,
So the taxable gain isn't calculated based on what the deceased person originally paid for the gold maybe years ago. Instead, it's based on its value right at the time they passed away.
wow.
This can potentially slash the capital gains tax liability for the heir, sometimes quite significantly.
Mm.
So basically, years of potential appreciation in the gold's value while the original owner held it could become tax-free overnight upon inheritance. That's a huge potential benefit.
Wow, okay, so if the gold's value went way up while the original owner had it, I don't get taxed on all that appreciation when I sell it, only on any increase in value after I inherited it.
Precisely. That's exactly right. It's a major tax advantage with inheriting assets like this. However, the timing of when you, as the heir, decide to sell the gold still matters, of course. Any market fluctuations after the date of death will affect the final sale price and therefore the capital gain or loss you might realize.
Okay, so how do you actually figure out this capital gains tax in a practical sense? Like, what's the calculation?
It's relatively straightforward, actually. First, you need that new basis figure, which, like we said, is a fair market value of the gold on the date of death.
Right, value at death.
Then, when you later sell the gold, you subtract that basis from the price you sell it for. The difference is your taxable capital gain.
Can you give me a quick example just to nail that down?
Sure. Let's say the gold in the IRA was worth $50,000 on the day the owner passed away.
Okay, 50,000.
That $50,000 is your new basis. If you then sell that same gold maybe a year later for $7,000,
Mm-hmm.
your taxable capital gain would be $20,000. That's the $70,000 selling price minus your $50,000 basis. The tax rate you pay on that 20 grand gain will depend on your overall income tax bracket.
Ah.
And usually how long you hold an asset matters for capital gains rates, but for inherited assets sold by the heir, that holding period doesn't really apply in the same way.
That step up in basis really does sound like a significant tax break. Wow. Okay, now what about situations where a trust is named as the beneficiary of a gold IRA? That sounds like it could add another layer of complexity.
Oh, it definitely can, yeah. It's not uncommon for trusts to be named as beneficiaries, and this brings in a whole different set of tax rules and considerations. Trusts themselves are legal entities, right? And they're subject to their own tax rates and regulations,
Okay.
which could be different from the ones that apply to individual taxpayers.
So inheriting a gold IRA through a trust, could that be better or worse tax-wise, depending on the type of trust?
Exactly. One really important concept here is the see-through trust. You can kind of think of it like a clear window. If a trust meets certain specific IRS requirements, it can see through to the individual beneficiaries who will eventually get the assets.
Okay.
In those cases, the RMDs can be calculated based on the life expectancies of those individual beneficiaries,
Yeah.
which could potentially stretch out the tax deferral over a longer time, much like inheriting directly.
And what if the trust doesn't meet those criteria? If it's not a see-through trust?
Well, if the trust doesn't qualify, then the RMDs could be accelerated, meaning larger distributions might need to be taken out more quickly.
Faster payouts.
Right, which could potentially lead to a bigger overall tax bill.
Mhm.
Because these rules around trusts as beneficiaries are pretty intricate, it's absolutely essential to talk with an experienced estate planning attorney to make sure the trust is set up correctly to get the tax results you want.
This whole area just seems pretty intricate, honestly. It feels like you could easily stumble into some kind of tax pitfall if you're not really sure what you're doing.
That's precisely why getting professional advice is so crucial in these situations. When you're dealing with the complexities of inherited gold IRAs, getting guidance from a qualified tax professional is really highly recommended.
What specific expertise can a tax pro bring to the table here?
Well, a tax professional, especially one who specializes in retirement accounts and maybe estate planning, can give you advice tailored specifically to your situation.
Right, personalized.
Exactly. They can help you fully understand all the distribution rules, make sure you're navigating the required tax filings correctly, and advise you on any state-specific laws that might affect your inheritance.
The article also mentioned talking to an estate planner. How are they helpful in this context?
An estate planner tends to take a broader view, looking at your whole financial picture and the overall estate plan. They can help structure the Gold IRA inheritance in a way that's most tax efficient, not just for that one asset, but for everything you inherited. And they can also advise on strategies for things like, potentially avoiding probate court. It's really about creating a comprehensive plan for how wealth gets transferred and managed effectively.
Before we wrap up, the article had a helpful FAQ section. Let's just touch on a few of those common questions listeners might have too. First one, does the specific type of gold in the IRA, like coins versus bars, have any impact on the taxes for the heirs?
According to our source, no. The specific form of the gold itself doesn't directly affect the taxes for the heirs. What really matters for tax purposes is the overall value of the gold when you inherit it, and then any gains you realize when you eventually sell it.
Okay. What about taking an in-kind distribution? That means getting the actual physical gold itself. Does doing that help you avoid taxes?
So opting for an in-kind distribution where you get the physical gold instead of having it sold inside the IRA, that doesn't trigger immediate income tax.
Ah,
But, and this is important, when you eventually decide to sell that physical gold, it will still be subject to capital gains tax. And that tax will be calculated based on the gold value at the time you inherited it, that step-up basis we talked about.
right.
So you're not really avoiding the tax, you're just delaying it. For instance, if you inherit $50,000 worth of gold in kind and then later sell it for $70,000, you'll owe capital gains tax on that $20,000 increase.
Got it. What happens if the person who owned the Gold IRA didn't actually name a beneficiary, like forgot or just didn't do it?
Yeah, that's not ideal. If there's no designated beneficiary on file for the Gold IRA, the assets typically just become part of the deceased person's general estate.
Oh, okay.
And this can unfortunately complicate the whole process. It might subject the assets to probate, which can be slow and expensive, and it might also increase the overall tax burden for whoever eventually inherits it. It really just highlights how important it is to have clearly named beneficiaries for all your retirement accounts.
Definitely good advice. And we touched on this earlier, but just to reiterate, state level taxes can also be a factor.
Absolutely. State tax laws about inherited assets, including stuff in Gold IRAs, can vary quite a bit. Some states do have inheritance taxes that might apply, so it's really crucial to check the specific laws of the state where the person who passed away lived.
Finally, how do heirs actually go about paying the taxes on these Gold IRA assets?
Okay, so heirs pay income tax on any distributions they take out of the inherited IRA.
Right, income tax on distributions.
And then if and when they sell the underlying gold, they'd also be responsible for paying any applicable capital gains tax. The amount of tax, the specific rate, that can be really influenced by the size or the timing of those distributions and sales.
Mm-hmm.
And it's also essential to, be aware of and file any necessary tax forms, like IRS Form 1041 for state income tax, if that applies, or maybe Form 709 for any gifts that go over that annual exclusion amount.
So the big picture here really seems to be that while inheriting a Gold IRA can be a fantastic asset, truly understanding the tax side and planning strategically how you handle it is absolutely key to actually benefiting and maximizing what you ultimately keep.
Precisely, yeah. Understanding that step-up in basis, carefully thinking about the timing and the method of your distributions, being aware of how trusts might play a role,
Yeah.
all of that can make a really substantial difference in the final financial outcome.
And it really just underscores the huge value of getting personalized guidance from, qualified tax professionals and experienced estate planners.
Absolutely. They can provide that tailored advice you really need to navigate these often pretty complex rules effectively. What works best for one person might be totally different for someone else.
For sure.
Professional advice helps make sure you're making informed decisions based on your specific circumstances.
Well said. Considering all these nuances isn't just about the mechanics of managing an inheritance. In a lot of ways, it's really about thoughtfully preserving a legacy. So maybe something for you, our listener, to think about: what specific steps will you consider to help ensure not only your own financial future, but maybe that of your loved ones remains golden?